Welcome to the latest edition of Cantillon Effects. And this week, of course, we're going to have to deal with central bankers. It's wearisome that we have to rely only upon the thoughts and prognostications and prejudices of a small handful of men and women who have been elevated to positions of power not seen since mythical theocracies. People whose every word is hung upon, whose rhetoric, mostly empty as it is, can move markets and trillions of dollars and change valuations across companies and obligations around the world. We first had perhaps this round set off by the ECB with Mario Draghi's cynical Parthian shot, by which he tried to lock his successor, at that point unknown, into a program of continuation of the Draghi policies, of negative interest rates, of massive bond purchases, of whatever it takes. The same whatever it takes that has largely innovated private sector credit creation and made a nonsense of bond markets and pension arithmetic across the continent. Following up from him, just about everybody's chipped in with the same program. For instance, Benoit Cœuré has said that the ECB is now ready to use all the instruments that have largely left the patient still in the critical state in the intensive care unit for a decade, and which, of course, the same sorts of instruments and the same sorts of people wielding them who were the ones who put him there in the first place. Kuroda in Japan at the moment has not moved, partly because there's much internal resistance in the Bank of Japan to continuing his policies, but he has said that if the government wishes to up the consumption tax later in the year, he'll compensate for it, which rather begs the question of what the purpose of the consumption tax hike is. He's also said that he's ready to make adjustments should the Japanese economy continue to stumble, even though the stumbling is nothing to do with whether banks can or cannot find creditworthy borrowers and whether creditworthy borrowers can find solvent banks. It's an issue largely of what's going on in China, internally, what China is doing with America, and then what the Japanese government itself is doing with its Korean neighbors and trading partners. But of course, in this world, everything's a nail, and so therefore the only tool is a hammer. Geert-Jan Vlieger at the Bank of England said if there's a no-deal Brexit, then he stands ready and willing to agree with a move to the zero lower bound in UK interest rates. Because, of course, if you can borrow money at 0% rather than at 0.25 or 0.5%, that will get your truck through the Calais paperwork much more swiftly and much more easily. I mean, my shoes hurt. Cut rates to 0%. It's raining when I want to go out for a walk. Let's cut rates to 0%. My dinner's cold. Let's cut rates to 0%. This is an absolute falsehood and fallacy and lunacy, but we're going to pursue more of it. As for the Fed, well, Mr. Powell talks of uncertainty, and how therefore they might need to buy some insurance. But what is the root of the uncertainty? The uncertainty is partly because we don't know what central banks are going to do. We certainly don't know what financial regulators are going to do and the legislators behind them, especially in light of the ideas that we're now going to audit every company for its supposed impact upon the climate, and we're going to funnel monies preferentially, institutional, private as well as governmental, to whoever can come up with some scheme to prevent the supposed looming climate catastrophe. The uncertainty is, of course, nothing to do with geopolitics in the Middle East and the US abrogation of the nuclear deal with Iran. It's nothing to do with the internal struggles of Xi Jinping in China. It's nothing to do with the trade wars, which all of these are geopolitical. All these are political decisions. They're ideological decisions in some case. They're cynical grabs for power and prestige in others. But none of these are anything to do with whether the credit system is functioning, whether entrepreneurs are being prevented from creating wealth and employment because of the level of interest rates per se. But no matter, these days the only thing that counts is, are the central bankers on board? Are they happy with things? Can they use their one tool, their one hammer yet again? Over the past 100 years, the central banks, despite their successive failures, have miraculously been elevated. Every time their work and their influence collapses in a calamity, they rise from the rubble phoenix-like, on the ashes, phoenix-like, even more powerfully endowed, even with even greater sway to move. Because of course the disaster before was not that they did something, whether by commission or omission, that should not have been done, but it was that they didn't do it enough, that they didn't have sufficient powers, that they didn't react vigorously enough. And so onwards, onwards, onward, Flucht nach vorne. We have gone from the gold standard, the classical gold standard, and the first flourishing of international trade and the freedom of peoples and goods. Through the disaster of the First World War, we ended up on the gold exchange standard, a very poor shadow of it, whose internal flaws were well examined at the time and which collapsed amid the horrors of the Great Depression. The Second World War led us through to the gold dollar standard, which was possibly a shadow of the gold exchange standard. And that, of course, lasted us until the late 60s, early 70s, where somewhere along the line we ended up on the Goldman Sachs standard, where basically every over mathematical genius at an investment bank got to try some fancy dan new instrument, put the world into greater jeopardy and more complexity than it ever needed before, and then probably toddled off to work at the central bank, because of course his expertise there was much more highly prized. From the Goldman Sachs standard, we're now arguably on the Golem standard. In other words, the central bankers are now these unthinking robotic creatures who have one goal given to them, and one goal that they will pursue no matter what the consequences of their actions. We have gone from a world where we used to want to own gold to one now where we continue to score own goals. Some say we are on a PhD standard today, but what we're actually on is a snowflake standard, because every time some little wrinkle happens in the economy, we must cut rates to zero or through zero or below zero and extend that zero out across the curves and out through the maturities and promise to keep it there forever through forward guidance. This is not a world in which capital can be allocated. It's arguably not a world in which capital can be formed as readily as it was before. It's certainly a world in which capital is at greater and greater risk of being wasted. It's not doing anything for entrepreneurship. It's not doing anything for progress, but we're going to be stuck with it. So let's have a look and see more specifically where we are in markets and what some of the consequences and what some of the background features are which have led to this, and which may give us some guidance as to how we will go onwards from here. And there's possibly no finer example of where this madness has taken us than in the German Bund curve, which we have here broken down for you, this time split out into the 1 year implied forward. So we have the 1 year starting in 2 days time, we have the 1 year starting 1 year after that, and so all the way out until in 9 years time we have a 1 year that ends 10 years from now. And if you look at this, you have to go out all the way to 2028 before you can find a 12-month period which has a positive interest rate. So in other words, if you're a German pensioner saving for your retirement, in 9 years time you will finally get something that is not actually a hidden tax on your savings. That's how crazy the world is, and this is before the ECB has even begun to do anything. All it has done is talk about it. All it has done is appoint the highly political and somewhat dubious character of Madame Christine Lagarde to be its head. Nothing yet has been done, and yet you have to go out 9 years to find a positive interest rate. Fortunately, for now at least, things aren't quite so crazy in the US Treasury market, although they're pretty bad even so. What I've tried to do here is show a slightly different version of this. So if you bear with me, the calculation says if I had a bond today that I owned for a 1 year period, what backup in yield would mean I made zero return? In other words, what would offset that 1 year's coupon interest? And then I've looked at the volatility that that particular security has undergone over the last 12 months. And I've calculated a rough probability. I've said, so what are the chances that if the bond behaved as it has in the last 12 months, that you would end up losing money by holding it for a year? And I've plotted here the 2-year note on the bottom and the 20-year note in black. You can see that the 2-year note only really got us in trouble. Any sort of meaningful probability that you could gauge on that basis when interest rates were very, very low indeed, way back in the 1950s and in the worst of the QE era when we were almost at zero interest rates. The 20 years is a different animal, of course, because it's much more variable. It's much more sensitive to yield. It has a higher duration, as we say. And with this one, however, you can see quite clearly that where we are now, you are pretty much saying there's a 2/5 chance that if you bought this thing today, and if it was just a random movement, you'd end up losing money on it. And that is the highest in the modern era. So even in the US, things are still crazily out of line. Of course, there are many ways of showing this highly self-fulfilling search for yield and hunger, and one of them is to show swap spreads. Theoretically, swap spreads should trade somewhere over treasuries because the underlying bank credit is not as good as the US government in its own currency. But the suppression of yields in total and the new rules and regulations which apply to pension funds mean that these guys are now very much liability driven, and so they desperately need to offset those future liabilities by receiving fixed income payments no matter what the level almost. And you can see here again that we've been driven down through into the negative part of the curve at the far end, so that the swap trades underneath the treasury, which we've already shown is ridiculously expensive. And you can also see in the corner over here how the latest yield move has again driven yields to the bottom. Chase the yield never ends well. And just to put a little perspective on the issue, here's a chart going back 50 years of US Treasury yields minus the CPI, this time the median CPI, and you can see that except in the great inflation back here with the 2 oil shocks, this thing has never been as expensive. It's never given such a low, scanty yield as it has today. With a sleight of hand change of the measure of CPI to the normal one away from the median, we can now go back a further period in time. So we're now going back to 1924, and you can see there's quite a nice distribution built in here. Very, very big degree of kurtosis, as they say. The nose is very heavy in this, and the tails are very thin. But again, you can see very seriously subpar on this measure. Not quite as extreme as it was with the median CPI, because today's traditional consumer price index tends to be somewhat suspect in that regard. But again, not offering any value of any sort, even if we take into account that most of us grew up in an era where this was actually the abnormality, and that somewhere in here at 2.5% real interest rate was the norm. Again, it's not hard to see why bonds are here. This is the net futures positioning for the so-called asset manager category that the authorities at the CFTC report for us. And I've taken here the durations of the cheapest to deliver bonds and converted them into 1 year equivalents. And you can see that we're pretty much off the scale in all of these things. Never seen such exposure to the long end. And whether it's 5 years, 2 years has dropped back a bit of late, but 5 years, 30 years, 10 years. And what is interesting as well, as you can see, is that over this period we've added what's called a barbell strategy, which is something you do if you think volatility is going to pick up, because it gives you slight advantages. You lose slightly less money than sitting in the middle of the curve if yields go against you, and you make slightly more if it goes the other way, something called positive convexity in the bond. Again, an extreme difference in the positioning between the longs in the two wings and the residual longs in the belly of the curve, also exacerbated by the fact that where the yield curve dips, we go from a relatively high front yield, we dip into 3, 4, 5 years, and then we climb out again to 10 and 30 years. So asset managers are there all over it. And the flip side of those asset managers buying treasuries, of course, is that mom and pop are buying bonds and money market funds in enormous quantities. I've taken this chart on the left from the period when the stock market turned after the Q4 sell-off, just after Christmas. And I've plotted the cumulative equity flows and the cumulative bond flows and the cumulative money market flows. And in fact, what you can see here is in that period, we've added over $200 billion to bond funds. We've added over $200 billion to money market funds, the bonds being the orange columns and money market funds being the blue area. Whereas equities we've sold off. We've continued to sell off despite the recovery in the market. There's been no sponsorship from retail in here and whatever institutionals play in these funds. In fact, we've dropped 65 billion in domestic equities, 23 billion in rest of the world equities. And the real crux here is when the market, again, sentiment turned quite markedly here in the middle of April. And you can see that although overall flows are not very high, we've sold off 70 billion in equities. We've bought 100 billion in bonds and 150 billion in money market instruments. And if there's any other need to say that mom and pop are not the ones long the stock market, here's treatment of margin debt, the money that you borrow with which to buy stocks. Now, what I've done here is I've scaled this against the market cap of the underlying index. And you can see that in absolute terms, we're actually as low as we have been at any time in the past 12, 13 years, since before the crisis, since before the GFC. The Q4 sell-off has not been replaced. And this blue line is the deviation of the red line from the dotted trend. And you can see the deviation has only once briefly been matched, and that was almost 30 years ago at the start of the 90s. So mom and pop love bonds, love money markets. They're not that keen on equities. So what does the Fed think it's playing at? Well, certainly if we look at the CPI side of its mandate, there are as many measures here as there are leaves on a tree. And of course, the Fed tends to cherry pick, if we're not overdoing the arboreal metaphors there. And it doesn't look at this median CPI, but this tends to be, to me, the best behaved one. And you can see that the median CPI is actually at the median level of the last 30 odd years since we broke the inflationary fever of the 70s and the 80s. We're right slap bang in the middle of this distribution. We're right at the middle of it. We're right at the mode. We're right at the median. But we're certainly not at median interest rates, and we're talking about cutting them. If we do focus at the other side of what the Fed's supposed to achieve, i.e. full employment, without going into the question of whether that's something a central bank can actually accomplish, there is a bit more justification for the change in tone. In fact, whether it's by serendipity, by sheer chance, or however it came about, the fact that the Fed changed course and abandoned its automatic tightening and then gradually morphed into promising rate reductions took place as the economy decelerated sharply. Now, at the time it was thought that Powell had given in to Wall Street and was playing plunge protection. It then became the idea that he had just knuckled under to the bully pulpit of President Trump. But the data on the real side do show signs of a marked deceleration. So certainly the idea of tempering back the schedule of rate hikes has some substance to it. Here we have a picture of US private payrolls, by which we mean the hours worked, as according to the monthly report, times the wages earned. So this is effectively a gauge of how much employers are paying out for the work being done within their factories, offices and shops. And you can see here that back when the Fed was on automatic pilot to hike, back in the autumn of last year, this measure was running at 5.6% annual, which was the best we'd seen since the crash. However, since then, boom, it's shot right down to 4.7%. That's the slowest we've seen in nearly a year and a half now. And if you look at the rate of change of that rate of change, the deceleration, acceleration if you like, we're now as negative as we've been since we crawled out of what I call the hidden depression in the end of 2016 and beginning of 2017. So here we have some evidence that the Fed's shift from tightening was actually justified. Now let's pull out a bit further from that picture. The graph we've just shown you basically incorporates this little squiggle here. But now we go back to 1964, so we're back 55 years, more than half a century. And what we're plotting here is the same rate of change in payroll earnings, but this time against the arithmetic change in Fed funds over the same year. And you can see that while not a correlation, there's a broad sense of the patterns following each other. When the amount of wages being paid accelerate, just as here, the Fed tends to follow by hiking rates. When they slow down, the Fed comes back the other way. And you can see the peaks and troughs, broadly speaking, are aligned all along this picture. So yet again, we have a view here of a real world phenomenon which says when the Fed abandoned its rate hikes, it was not just placating Wall Street or sucking up to Donald Trump. It was doing something which, in hindsight, certainly made some sense. Now it's a similar picture when we look at business revenues of manufacturing, wholesale, retail put together. Back in the autumn last year, we were running at 8.2%. Again, the best since the bounce out of the great financial crisis. But since then, we've not quite hit a brick wall, but we've definitely thrown out the anchors and put up the air brake, because we've gone from 8.2% to 2.1%, which is the worst since we crawled out of that hidden recession in December 16. And again, look at the correlations, look at the similar pattern, I should say. Every time we get a spike in business revenues, in other words, the economy accelerates, if you like, nominal GDP goes faster, then the Fed tends to raise rates. This again is a change in Fed funds rate over the year. And here we have all this plotted as a scatter graph, and you can see there's not a bad relation. Even then, you have an R squared of 52, which for such a simple single extracted indicator is not bad at all. What this says is that when growth starts to accelerate beyond around about 6% a year, the Fed starts to think about hiking. And where we are now, 2.1%, is in here. I don't know if you can see that that yellow line. I put a red one in here. We're in here somewhere. So the Fed has not yet reacted, although it's within the scatter bands, to the way it would have normally done before. So once again, this deceleration tells us that the Fed, whether it's in retrospect or not, was probably justified in stopping hiking. Whether it yet is enough for it to give it a sensible reason, given all the other things that are going on for cutting, is a different issue. Now, the ISM index is one that everybody focuses on. I still call it NAPM, being old school. The so-called soft data rather than the hard data. But in fact, the hard data and the soft data are pretty well correlated. If you look at it, again, we've got the change in NAPM, the arithmetic change from one year to the next, not the percentage change, the arithmetic change, against the acceleration or deceleration in those business revenues we looked at on the previous slide. And you can see here, this is again a long period of history. We have a very good correlation. So in other words, NAPM tends to pick up. We get better readings from businessmen. They're more optimistic when they answer their surveys, and they tick a box saying things are better than they were last month when their sales are starting to accelerate. Very intuitive, very sensible. So what we've done now over here in these other two graphs at the top is we've looked at the NAPM index, its change year on year, arithmetic. There's a slight trend in this, which I've taken out, and obviously taking out the trend means that we can squeeze it for the normal variations. And I plotted that here against the change in high yield bond performance against investment grade performance. Again, not a bad fit. High yield tends to underperform investment grade at times when things are beginning to get stressed, which tends to be when business revenues are starting to decelerate, which shows up in a falling NAPM reading. And over here we get a similar but not quite so good fit with the infamous 2's10 yield curve. So what we're saying here again is as financial conditions tighten, which is what that inversion, that flattening and inversion often signify, then the squeeze means that the NAPM index starts to fall. All very sensible, all very intuitive. We have some financial signals here which are fitting in with the survey, and the survey gels with data out in the real world in business revenues, and these are things which give signals to the Fed. Now, if there's one thing, of course, which the Fed is supposed to be able to control more than anything else, it's the supply of money. But in fact, the Fed has allowed, or the system has resulted in, the supply of money, again, slowing dramatically. Real M1 has been flirting with zero and dipping into negative. The last time it did that was just before the crash. The last time it did that was before the tech bust. We have a false signal here, which is partly to do with the fact that Alan Greenspan greatly changed reserve requirements there, and there was all sorts of confusion and misrecording between the different categories that of deposits and bank liabilities that make up this figure. But before the 89-90 crash, real money went negative, real money went negative, real money went negative, real money went negative. This looks like a false signal, but in fact the OECD recession indicators track this as a recession in the mid-late 60s. So this is a pretty solid indicator. The only caveat here is that because of the vast excess of narrow money, of reserve pumping that the Fed engaged in QE1, 2, and 3, and because of the collapse of interest rates to near zero, which meant opportunity cost between various forms of holding almost disappeared, there was more narrow money, more M1 type money in existence compared with the other stuff than there has ever been. And people were happier to hold it given they had less penalty for doing so. So there is a little, it is different this time, that we could possibly read into this chart, that the money growth collapse is re-switching back to a more normal balance of holdings. Now we saw that earlier when we looked at this enormous appetite for money market and bond funds. Now that they show some reasonable pickup over overnight money, or that they did show some reasonable pickup, and added to the fact that, of course, they were being used as safe haven instruments. Now, this is the slide where we try to show this. It is different this time because adding to the commercial bank deposits, we've put in the money market fund growth. Now, we can argue about whether this should be included in money or not, as in the most liquid, the currency element, the thing with which you settle your bills, the medium of exchange, so on and so forth. But if we're looking across the categories, the slow growth in bank deposits is largely being compensated by the growth in money market funds and, of course, bond funds, which are not showing up on here. So this re-switching element, I think, is real. And if we look at this one, you can see that, again, since the late autumn, early winter of last year, there's been a marked acceleration. The red one is percentage changes. So we're in the highest percentage change here that we've seen in, well, quite some period, for 4 or 5 years. And in terms of the increment that we've added $900 billion or so, getting on for, which is the biggest amount since we were QEing and pumping money into these systems. So the slow growth in bank deposit growth, which is partly reflected in the slow growth in money supply, is in at least some measure a consequence of re-switching into non-bank savings instruments. And so we had money supply was overstated when it was being used not just for transactions, it was being used for savings. Now that those savings are going out somewhere else, the growth in money supply looks small, but in fact the transactional element between those two periods may not have been so badly affected, may not have been so reduced, and therefore that's possibly why the vast surplus of money over the past 5, 6, 7 years since the crisis, in the early part since the crisis, has not led to so much more churn in economic activity and, of course, inflation, and why the fall off now has also not been as exerted such a radical effect on what's going on in the real system. So this very much needs to be borne in mind. And the one thing to note here is that even if the economic case is somewhat balanced, much more nuanced at least than the market is wishing to give it credit, the argument in markets is, if anything, much more clear-cut. One thing the Fed does not want to be doing here is exciting more speculative activity. It does not want to be encouraging more borrowing to chase prices, to chase yield, to indulge in behavior which ultimately will undermine the foundations of the economic entity. It doesn't want to be putting wood in that it thinks is shoring up a structure, which is simply adding fuel to a bonfire. And the danger that that is the case is clearly seen here when we look at the classic bellwethers, the storm beacons, gold, and of course the new champion of this, Bitcoin. So gold has rallied 14.5% in what, 11 weeks, and in that period we have had the fastest ever accumulation of longs, a switch from short to long, which themselves are at several year highs, but the pace of the change is a record. We've added 216,000 contracts. Now, to put that in context, that's the equivalent of 673 tons of gold. That's 16 times what the Chinese central bank has bought at the same time, about which so much fuss is made. And pro rata, it's over 90% of worldwide mine production in that same period. And then we have Bitcoin. Bitcoin, 240% rally. Thin air upon thin air. Does the Fed really want to be stimulating this sort of behavior? And gold, of course, is expensive against a number of other commodities, and particularly its old partner, silver. Here's a chart going back 35 years or more, and we can see that there has only been one brief period in this whole stretch when gold has been more expensive relative to silver. Now, this is a market going one way, so you have to wait for a reversal, but arguably in the last 24-48 hours, we may have had one. So you certainly know where your stop loss is now if you do the trade. And what you're looking for is at the very least, to trade back to this big high volume area down here at about 75 to 1. So that's not giving you a bad risk reward ratio if your stop loss is in and around here and your execution point is here. Worth bearing in mind. Now, for all the breathless chitter chatter about stock markets making new highs, yes, the capitalized weighted ones that we traditionally look at are, but the average stock has actually not got anywhere. This is what the value line measures, simple arithmetic average, and it hasn't got anywhere since mid-17. So not everything is overpriced, and even the things that are overpriced, or arguably overpriced, may be so in isolation in absolute terms, but that's not the world we live in. We don't live in an absolute world. We have to compare what's happening in the stock market with what's happening in the bond market, and the bond market is of course being driven by central banks. So the artificiality comes in from there. The discount rate is important, whether you're doing a calculation of bringing back the prospective earnings stream that you see and working out what that should be worth today, or whether it's activity in corporate finance, stock buybacks, M&As, private equity, or whatever. The discount rate is critical, and when you take that into account, stocks aren't particularly expensive. It's the bond market. There's no one definitive way to try to illustrate that, but here's an attempt. What we've done here is we've compared the earnings yield, which is the inverse of the PE on the stocks, to the bond yield. So we're looking at what the income thrown off theoretically by the equity portion of its capital is against the bond portion of its capital. Now, this ratio can vary, this difference in fact can vary, depending on whether stocks are becoming expensive or bonds are falling off and their yields are rising. So we have, for example, here we have a pinnacle where we have the tech bubble, which is pushing stock prices up. Then we have the credit crunch of 2002-03 when bond yields are going up. Here we have the great GFC soaring corporate credit rates through the roof and making therefore bonds look very cheap after the event. But here we are, look, here's the QE NERP era. We're way down here. It is comparable with where we were back in the early days, before we started to build inflation in, before we started to think that we had a chronic world where prices were always going to rise and the relation between these two changed. But it's way below anything we've seen in the intervening period of, in quote marks, normality. Now, in the short run, the bond market provides us with a little bit of a conundrum. This is how I read it. So back in November, when we had the great risk asset sell-off and we were all flocking to bonds and the Fed was starting to change its pattern, we clearly sparked a rally in treasuries. If you look at this, this is a classic market profile. We've moved down, 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 down. We balance out sideways, and then we have a move of pretty much the same magnitude out to the bottom. Well, we got there in June. So that profile is finished. Now, what in a classic example would have happened, it would have then traded back, rejected that low, and edged all the way back up into the middle. It would have done something like this. But what we've done instead, because of all this central bank change and this added information and this added shift in sentiment, is we've hovered about here. We made a new low, yes, but since the beginning of June now, for 6-7 weeks, we haven't really got anywhere because we're into, are the Fed going to cut? Are they going to cut 25? Are they going to cut 50? Or maybe not, 25. Oh, the economic data is horrible. The economic's not so bad. And we're washing. So the clear thing to watch for now is how we come out of this band. If we go out the bottom, heaven help us. We are back into, everybody will talk about the Fed doing what the ECB has done, doing what the Bank of Japan has done. There'll be no end to it. If, however, we come back up the other side, it will be in the short run bad for the other assets that have traded where they've traded because of this movement, but ultimately it might restore a bit more balance. So watch this little pattern in the bottom corner. For those of you who are fans of the designation of copper as the doctor of the world economy, you can derive a certain amount of bearish comfort out of the fact that the metal has fallen back to levels which it was trading at the very beginning of this mini recovery in 2017, levels which are pretty depressed still from the highs we saw over the previous cycle. But there is one small source of comfort in here and maybe a trading opportunity to watch for. You see this trend line that's coming up from the hidden recession, the Trump reflation, through here. So far holding in about the middle of the range that we've set there. But look what's happening in the positioning. We've got record leveraged hot money shorts in here, and they've been trying to push it and they haven't really got anywhere in the last couple of weeks. So what we need to be careful of here is that these guys get fed up, get stressed, get tripped out. We get a short covering rally here, we trade back up and possibly take this minor trend line out. So could copper do this? I don't know. I mean, this pattern itself is top heavy, which suggests it still wants to trade down here. But watch what the specs are doing. Have they run out of steam? Have they pushed it too far and left us vulnerable to a short-term correction? Oh, there's another case in point. The rally out of the middle of 2017 pretty much hit its peak on the day that we had that great risk asset reversal in the fourth quarter of last year. And then, boom, the oil price crashed all the way from $87.50 all the way down to the mid-40s. Pretty horrendous stuff. And then at Christmas, Boxing Day, we have the reversal in the stock market. We get a reversal in commodity markets as well. And up and up and up we trade, and we take about 2/3 of the sell-off back out. And then in April this year, this is when again we had a change in risk sentiment, pretty much I think related to what was going on in China and the growing woes there. And again we have another sell-off, takes us to another fib retracement, and we've oscillated into the middle. Now on the shorter scale version here, you can see we are pretty much midway and at the node, but you can also see it's top heavy, much more volume here, which means there's risk if we break these supports. We have to do a lot of work down in here. Even the bigger picture, it's not quite as clear, but the bigger picture also is top heavy. There's more up here than there is below. So if it breaks through 63, 62, we could be in trouble. Now the implication of this is not just for oil traders, because if oil prices sell off, the 5-year inflation gauge in the States, the 5-year forward implied inflation rate, will also sell off, because these two things track each other. As ludicrous as it is for something which is the price of a gallon of oil today, it's supposed to tell us something about how CPI will perform over half a decade hence. That's the way it works, and that's a signal that central banks and bond market traders watch, because they've taught each other to watch it. So if oil breaks lower, the 5-year breaks lower, we'll be back on with lower bond yields. We'll be back on with, is the Fed behind the curve? And we'll be pushing once again in the direction that we've been in for the past several months. Now, sometimes one of the best indicators in a market is when it doesn't do what it's supposed to do. So here we are all now talking about, is the Fed going to do 50? Whereas 6-9 months ago, we were talking about, was it going to do 50 in the other direction, i.e. hike? And yet the dollar hasn't significantly weakened. Here's the Euro US chart. And look, the euro is still, okay, it's washing around in here between, I don't know, 111, 115, 112, 115 kind of area in here. But the trend is low on the short term. The trend is low in the medium term. The trend is low in the long term. The euro is weakening against the dollar. So as somebody jokingly or ironically said, when Draghi and these guys started talking about their own movement in rates and the euro briefly rallied, they had lost credibility. They had supposedly lost credibility in trying to destroy the credibility of their currency. But in fact, they haven't destroyed it at all, because the Fed's been the one doing all the talking since, and yet the euro can't catch a bid. Now we have a lot of congestion down here in the bottom end of this trade. So this is slowing progress, but we have a nice pattern here. Again, down, consolidate. The chances are we could trade all the way back to 105, even parity, if we get the break through this year's lows in euro dollar. It'll be something that everybody jumps on. And where that becomes significant is on the real big picture of the US dollar. And we're kind of flipped around from the other chart because that was dollars per euro, and this is the dollar as a trade weighted index. The question is, you can see that the peaks, the super dollar peaks, the highs are pretty much separated by the same sort of period of time. The lows also tend to have a little cyclical pattern. Theoretically, we're somewhere where we should be seeing a high, and we should be trading off out for the next 4 or 5 years to a new low, maybe 40% below where we are now, if the past sell-offs are any guide as to the magnitude. But intriguingly too, we're also in this pattern where we've rallied up, traded sideways, and hit right into a nice nose here. The big long-term trend off the peaks, the medium-term trend off the post-crash move. If this one breaks higher, we got 20% instead of going down 40%. So this nose, which on this chart at least is somewhere to be seen in the next 6, maybe 12 months, could be critical for the direction beyond that, for a big move. So the first thing that would push this through is if that possibility we suggested in the previous slide of the euro breaking down, the dollar breaking up, does come to fruition. That just might be enough to start to push this chart into making a decision, which is a medium-term decision of significant import. So keep your eye on it, please. Well, thank you for your attention, ladies and gentlemen. I hope that gave you something to think about and ponder over the weekend. I hope you found it enjoyable, entertaining, possibly also informative, and maybe even useful. Happy to take some feedback. info@cantillon-consulting.ch or cantillon.ch on the Twitter handle. Let me know what you think of it, good or bad, and I'll try and take into account your feedback and your preferences. And of course, if there are any questions, that's the way to pose them to me. So for now, again, thank you very much and have a good weekend. Bye-bye.